This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the JDfn FOREX Report.
Good afternoon, this is David Petrinick with the Market Wrap. The rally back against the dollar began around 7 a.m. Eastern Standard today as the U.S. stock futures showed less weakness than was anticipated. With the strong opening in the stock market at around 9:30 a.m. Eastern Standard, the dollar had more reason to sell off. The dollar sell-off today has been impressive, yet not all the majors have broken last week's highs. The pound dollar and the New Zealand dollar have broken the highs, yet currencies like the euro and Aussie are still holding beneath last week's highs. While the pound dollar and the New Zealand dollar look the strongest, they could still hold up the ascent and consolidate sideways. The euro dollar and Aussie dollar, on the other hand, look the most probable to continue the ascent and to test last week's highs in the near term. In the news today, Canada's currency rose against the dollar as a report showed a surge in U.S. consumer confidence. UBS AG, the world's second largest currency trader, is calling for a top in the euro as they expect the euro will soon slump as global demand is expected to continue shrinking. A disparity between the credit markets and stock markets was reported today, with the credit markets showing a full recovery since the September lows, while the S&P 500 stock index still sits 10% away from a full recovery. This indicates that stock investors are not convinced that the economy and profits will grow fast enough to continue the buying momentum. The banks are not completely convinced that they are out of the woods either, as the LIBOR spread has widened significantly. A wider spread indicates that the difference between the highest and lowest interest rates has widened, and this signals that the lenders still lack confidence in each other. The dispersion of LIBOR submissions seemed to be exceptionally wide, said Mark Chandler, the global head of currency strategy at Brown Brothers Harriman and Company in New York. There is potential for bifurcation of the financial system between banks perceived to be healthier than others. This leaves many questions. This was David Petrinick with the Market Wrap. Have a great day and happy trading.